So let's start the session, my dears. So we are actually in advanced financial accounting. And let's start with the chapter one. As you all of you know, we have chapter one, that is financial statements, elements and components. And after that, we study about limited liability company accounting. And the chapter three is all about partnership for business finance. So we will study about partnership accounting. And the chapter four is all about not for profit organizations, and the chapter 5 is about cost accounting. So these are the entire units you are having. So let's explore with our chapter 1, that is financial statements, elements and components. So this is our very first chapter, right? We are starting the accounting journey in the level 2, my dears. So actually this chapter is all about understanding the some basic concepts of financial statements. You know, we are creating so many statements, right? As you are aware of your first level financial accounting, we are creating some documents or some statements. Actually, every business is creating to show how much money they have, how much money they owe to other people, right? How well they are performing. So there are different statements for different purposes. So that is financial statement. So let's explore about these statements and elements or the components of these statements. So let's talk about the learning objectives of this chapter 1 is identify elements and components of financial statements, right? So we have to identify what are the elements in these financial statements and it is components, right? We will call assets, liabilities, equities, income and expenses. We will learn about these things. And the second learning objective is explain different bases of accounting, right? There are case basis, actual basis. There are so many bases we can prepare the accounting. So we will study about that and explain the adjustment for prepayment, accruals, income tax, depreciation, acquisition and disposal of PPE, allowance for trade receivables and salaries including payee, EPF and ETF. No worries about these things. Just we are going to learn about adjustments, right? Adjustment for prepayment, adjustment for accruals, income tax, depreciation, right? If you are purchasing assets, non-current assets, if you are selling, disposal means selling, right? So elements for trade receivables and salaries including payee, EPF, ETF calculation. So everything we will study. Give me a minute. Right, let's continue. So explain the adjustment for prepayment, accruals, income tax, depreciation, acquisition and disposal of PP. So acquisition means purchasing of non-current assets. We call it as purchase or acquisition. And disposal means selling. PPE means property, plant and equipment, right? So allowance for trade receivables, we will learn about this and how we can calculate the salaries, including EPF contribution, ETF contributions. So these are the technical terms, my dears. We will explore in the chapters later. And let's talk about the fourth learning objectives, that is explain the basic accounting for WET and WHT. Normally, WHT calculations we are not going to be here. You will learn about these in the what do you call in the taxation subject. But usually we will explore about VET, value added tax, right? So value added tax, I'll explain about the value added tax and how can we calculate the percentages. Usually this is just a business mathematics things. How can we deal with the ratios as well as how can we deal with the percentages. If it is included VAT or excluded VAT, we will study about those things and explain accounting treatment and disclosure requirement as per the Sri Lanka accounting standards. So, my dears, for your chapters, we will study about LKS 2, LKS 8, and LKS 37 and LKS 10, right? So, these are the accounting standards we will explore, right? So, we'll study about these accounting standards very shortly. So, in today's session, I will try to cover these four learning objectives: the components and different bases and introduction of adjustments. Normally, my dears, this is not a theory subject, so I'm not going to talk about much theory about these adjustments. I will briefly introduce you about these adjustments, and after that we will directly move into the question and we will attack the question with these adjustments, so that will make more sense to you in examinations also, right? So let's talk about the 1.1, that is the elements of financial statements. So what does this mean actually? Just like, my dears, a house, right? A house is built with some bricks, not some bricks, more bricks, cement, as well as we use some steel. Like that, these financial statements are built with some five fundamental elements. These are like basic ingredients, right? Every financial statement in the world built with this, right? So there are five fundamental elements. So remember, there are five fundamental elements contained in a financial statements. So those are assets and liabilities, equity, income, and expenditure. Right. So before we dive very deep into these five fundamental elements, I'll tell you simply what does it mean by assets. The assets in the sense what the business owns, my dears, right? So what the business owns is called assets, right? The things of value. And the liabilities means what the business owes to other people. It has to give to other people the debts and obligations. And let's talk about equity. Equity means the owner's share, right? What belongs to the owner, right? What belongs to the owner, right? Belongs to the owner. Let me talk about this. Let's say owner's share. You know entity concept, right? In entity concept, we studied in the level 1 also. Owner is different from the business. So, if business is something different, what is the share actually the owner is having is called equity. And let's talk about income. What the business earns. Income is all about earnings. And expenditure is in a very high level, but the business is spends, right? So these are the five fundamental elements. We must know about what we are owning as a business, right? Business owns. Here, owns by business, okay? I'm not talking about owner here. Owns by business is assets. Liabilities is what owes. Equity is owner's share in the business. Income is what you are earning. And expenditure is all about spending, right? So if you understand these five elements, you understand almost 90% of your accounting, right? So let's dive very deep into one of the thing is asset. Assets, my dears, an asset is anything, right? Anything valuable that a business owns or control. That's a very important word. The business owns, also the business controls it. The control, that's an important part here, right? If you can help the business make money now or in the future, that is an asset, right? If an asset or if it can help the business make money now, in the present or in the future, it's called asset, my dears. So let's see the definition here. An asset is a present economic resource controlled by an entity as a result of past events. The important word is the present economic resource, right? You are having right now. It's a present economic resource as well as it is controlled by an entity as a result of past events, right? So, what does this mean actually? My dears, an asset is something your business has right now, as I mentioned earlier, that can bring money or some benefits. And also, you got it this asset because something that happened in the past. It means like you buy it, you earn it. So that's something, the definition of an asset. So an asset is present economic resource controlled by an entity as a result of past events, right? So this is the actual definition. So let's talk about the key characteristics. And assets have the potential to generate some future economic benefits. What about these future economic benefits? So the future economic benefits means, my dears, we are having the assets right now, as well as it's going to generate, might be money, might be will give some services. So these are the potential benefits we are going to get from the assets. That is economic benefits. It means in terms of money we can measure it. That's what the meaning of economic benefits. As well as these benefits can be realized directly, example cash, or indirectly through cost reduction, because you have a very good machine. It's not wasting your time, right? It's saving your time, so it's giving you cost reduction, or directly it will give you the benefit of cash, right? So these are the characteristic, my dears. So it will give you economic benefits. Also these benefits can be directly come as a cash benefit, or it will be indirectly come like cost reduction. So let's talk about the ways the economic benefits can flow into the business. Economic benefits means we are going to receive some benefits that can measure in terms of money. That's the meaning of economic benefits. Now, why the ways of economic benefits can flow into the business? The first way is use in operation, right? It means you are having that machines, you are having that plant, you are having that machineries, you are having that assets, laptops, right? Buildings, whatever, right? And you are using that in the operations, in the manufacturing, in your factory, to produce the goods and services. So manufacturing goods or providing services is one of the economic benefits. That is actually, we call it as use in operations, right? So you are going to use the assets in our operations. You can see these are the machines here, right? You can use the cash to pay your suppliers and other things. So you can use in operations. Like, let's say you are having a printing machine, right? So you are having a printing machines and your business is, printing wedding cards. So that machine helps you to earn money through its operations, right? That is, use in operation is one of the economic benefits an asset can give you. As well as, let's talk about the exchange. Exchange mean what? Trading for another asset. For example, you are having a small shop, right? And you have an old delivery van. So you are going to exchange that delivery van for the car company and you are getting a newer one. It means you are exchanging one asset for another. So it's also going to give you the economic benefits, because you don't need to pay the cash for the value of your old van or old assets. That is something called exchange. So you can exchange your existing assets to get a new assets or get something new. That is exchange. So the way exchange will give you economic benefits to the business. And let's talk about the settlement of obligations. So settlement of obligations means using the assets to settle our debts. Debts means our liabilities, our loans. Let's say you are having a cash actually an asset of the company, right? You are having an asset and you are using the cash as an asset and you are paying your bank loan. So you are using that asset to settle your liability. No, that is one of the economic benefits it's going to give you, right? So you can pay your debt through the cash, or other assets also you can, mortgage, and you can pay that, right? As well as distribution. What is that? Handing out benefits to owners. Let's say you are having a spicy shop in Kandy area and you are withdrawing, let's say, rupees 50,000 from the business for your personal use. It means it is distribution. For the owners, it is distributing some money. We call it as drawings, right? It's calling as drawings. So these are the ways, my dears, the economic benefits can flow into the business, right? So let's talk about the classification of assets. Now, the assets. the present economic resource that controlled by an entity, and it will generate economic benefits in the future. So how can we classify these assets? Right? There are three different ways, my dears, we can classify an asset. The first one is based on the physical existence. Based on the physical existence, we can classify the assets. And the second one, based on the liquidity, we can classify the asset. And based on a certainty of realization, we can classify the assets. Right? So these are the three ways we can classify the assets. Let's talk about the based on physical existence. So here, my dears, we are going to have two categorization. The first one is we can say tangible assets, and the second one is going to be intangible assets. So these are the two categories under the physical existence classification, right? What's the meaning of physical existence, my dears? Physical existence means you can touch the asset, you can see the asset, you can feel that asset. That is physical existence, right? So based on that, we are classifying tangible items. So actually, we have to give these to this one, tangible assets. Okay, you can feel, you can see, you can touch, right? Assets with physical form, right? So the examples are the buildings, machinery, land, equipment, the vehicles, right? Everything. Let's say you are having a delivery van, right? You can touch it, you can see it, you can feel it. You have your building, right? The shelves in your shop, all are tangible because you can physically touch them, right? So that's what these are, we call it as a tangible asset. So the vehicles, the machineries, the buildings, everything is a tangible assets. You can see it. But what about these intangible assets? Assets without physical form. It means you cannot touch, right? You cannot touch it, right? Simply we can put it, you cannot touch it. So assets without physical form, right? There is no physical forms like building or machineries or equipment, vehicles, no. Intangible assets are without a physical form. So the examples are, we can call it as a trademarks, patents, copyrights, goodwill, right? Let's think about it in a practical way, my dears. Think about Keels, Cargill's very big brand, no? Keels, it's a brand name actually. Wherever you see the Keels, normally you will go with your car and you park and you will buy the things. That is the brand name. You can't touch it, but it worth millions of rupees. Let's talk about Dialog Exiata's mobile network license. There's no physical form, but extremely valuable. That's what, the classification of assets, these categories, it will be in paper, the brand name, right? The patents. Patents means the right to produce someone products. The owner is someone, but you have the right to produce, and you will pay for every unit you are producing. There is something called patents, copyrights, goodwill. Everything are intangible assets, right? Based on physical existence. Let's talk about based on liquidity, right? Based on liquidity. So first, liquidity means what? Liquidity is about how quickly you can convert an asset, my dears. Quickness, right? It's about quickness. How quickly you can convert an asset into cash. Some assets you can, make them become cash in hours. Sometimes some it will take years, right? So in that base, we are going to classify two things: non-current assets and current assets. Normally, my dears, in our income statement, we classify the assets according to the liquidity basis, non-current assets and current assets. That's what in our balance sheet or statement of financial position, we will have something non-current assets as well as current assets, right? So non-current assets are what? These are long-term assets with a slower cash conversion rate. So the very important 2 points are here. These are long-term assets and very slower cash conversion rates, right? We can use it for a long years, but we cannot convert it very soon as a cash. So less liquidity, right? So long-term assets with a slower cash conversions. So we can have examples of non-current assets, as you already know: land, buildings, plant, and equipments. All are non-current assets, but based on liquidity, it's less liquid. right? Let's say you're owning a building in Colombo 7 Colpity area, I think, right? You can't sell it in one day, no. It takes weeks, sometimes months to find a good buyer. You have to negotiate and you have to complete the sale. That is non-current assets. You cannot quickly convert it as a cash. It will take time. That's why it's less liquid. And what about current assets? Current assets are, my dears, always it is short term. We can confidently say these are short term assets you can very quickly convert into cash compared to non current assets, right? So the examples are stock, it means inventories that you are selling day to day basis, debtors, receivables, the another name of debtor is receivables, cash, bank balances, everything we call it as current assets, right? So short term assets quickly convertible into cash, we call it as current assets, right? Let's say you are having a shop in Peta area. You can sell them today, right? The inventories, the groceries, you can get the cash immediately. And also, let's say you have a cash, actually, the cash in hand in your register, that is already cash. These are called it as current assets, right? So, my dears, it is about the liquidity basis. Imagine, let's say you need some money urgently. What is the easier option to convert to cash, right? Let's say you have a mobile phone with you. You can sell it today at a peta market. Let's talk about your house. The phone is more liquid than your house. Why? Because that's a current asset. The house is less liquid, like non-current asset, right? So let's talk about based on certainty of realization. What this means actually. Assets with fixed realizable value. It means you know exactly how much you will get. That is based on certainty of realization, right? So we call it as financial assets and non-financial asset according to the based on certainty of realization. The first one is financial assets, my dears. Financial assets always assets with fixed realizable values. So the important word is here, it's having a fixed realizable values. What this means actually, right? Let's say, let's say an example here, bonds, bills, treasury, securities. These are just a papers, my dears. Bonds means it can be treasury bills and treasury bonds. Treasury bonds are long term government bonds. It means you are going to give the money to government as a loan and government will pay after, after 30 days or 40 days or 180 days. Normally bonds are for long term, for 1 year, more than 1 year period. Treasury bills are actually short term, right? So these are financial assets. It's going to have a fixed realizable value. It means okay, you are giving a loan like 90,000. The government is going to return you 100,000. So you know the realizable value and the date, right? Let's say you are investing 100,000 in the Sri Lankan government treasury bills, and you know exactly how much you are going to receive when they mature. That is financial asset, my dears. So bonds, bills, treasury security, everything is a paper actually, right? That is financial assets. Let's talk about non-financial assets here. Assets where the realizable value is uncertain. There is uncertainty about the realization value. So these are the assets, we call it non-financial assets, buildings, and everything will come under this category, right? Real estate, inventory, equipment, who are not in papers, all are non-financial assets. Let's say you own a piece of land in Betiklova Jaffna area. What's it worth actually? It depends on the market, no? It go up or down according to the supply and demand for the real estates. Because the value is uncertain, it's always a non-financial asset, right? An example is here real estate, inventory, and equipments all will come under the category of non-financial assets, right? Now you have a very good understanding about the assets category, my dears, right? You know the definition, you know the key characteristics, how it's going to give you the economic benefits in the future, and what are the ways we can classify. And normally, according to the liquidity basis only, we will prepare the assets classification in the statement of financial position, my dears. Now, let's talk about liabilities, right? So, liabilities means the business owes to other people. The liability is the opposite of an asset, my dears. It's what your business owes to others. It means you promise to pay or give something in the future to someone or some company, right? So let's talk about the definition here. A liability is defined as a present obligation of the entity to transfer an economic resource. So the important word is here economic resource as well as the present obligation. You have the obligation right now, right? You have the obligation. That is present obligation, right? So it's a liability is a debt or obligation right now. That means the present obligation right now because of something that happened in the before in the past, which has arisen from the past events, right? We can put it in one sentence, my dears. That's better. Which has arisen from past events. It means, something that happened before, you must pay it or fulfill your obligation in the future, right? That's the meaning of liabilities. And let's talk about the nature of obligations. A liability is a current obligation that commits the business to certain actions. This obligation can be of two types, right? The nature of obligation in this sense, your obligations, how you are going to fulfill that. The first one is legal obligation. So the obligation can be created by legal or sometimes we call it as constructive obligation. What's the meaning of legal obligation, my dears? It's a duty enforced by a law. A duty enforced by a law because of something happened. Let's say, you have to repay your bank loan. It is actually a legal contract, no? Between you and the bank, there is a contract, bank loan agreement. If you don't do that, the bank can take some legal action. So you have to pay the bank loan in an installment and in an agreed way, agreed manner. That is legal obligation, my dears. Right? Legally, you have obligation to fulfill. And let's talk about constructive obligation. It means, see the notes, a duty that the business has implicitly or explicitly indicated it will fulfill. Usually because of past practices or some statements you have given. It's a promise, right? It's called implicitly or explicitly. Right? That's an important word, right? Implicitly means or explicitly. Implied or in an explicitly manner, you are indicating you will fulfill because of the past practices or something it happened. That is called constructive obligation, right? Usually it will happen because of something happened in the past. Let's say you are having a restaurant in Jaffna, right? And always, let's say you are going to give the year-end bonuses to your staff. So you are practicing that for a 10 years of period of time. Even though there is no legal requirement or there is no legal agreement between you and the employees, but you are practicing that for a 10 years period of time, your employees will expect it, right? So it's creating something called constructive obligation. So your obligation can be created in a constructive way or the legal way, right? So these are the nature of obligations, my dears, right? Now let's talk about how we are going to settle these obligations, whether it is a legal obligation or constructive obligations. What are the methods of settling these liabilities, right? There are four ways we can identify according to your syllabus. First way is the best way by paying your cash. The most common method, right? So you have bank loan, you have something. So there is a universally accepted currency that is cash, right? So you can pay your supplier rupees 100,000. You receive their inventory, so now you owe them the money. So you are paying through the cash for the groceries you received for credit, for the loan, right? That is one method. And another method by transferring another asset. You give something else of value to settle your liability. Let's say you are going to give your old computer to a supplier and you are settling rupees 25,000 debt you owe to them. That is by transferring another asset as well as by providing services. For the debt you owe to them, you are going to work for them. You are going to give some services. Let's say you are a graphic designer. You design the logo for the land owner to offset your month's rent liability. That is by providing a service. And let's talk about by transforming the obligation into another obligation. It means you are creating one liability to settle another liability, right? Converting one debt into another. Let's say you are having a short term bank overdraft, right? Now what you are doing is you are converting this bank overdraft into a long term loan. So one liability becomes another, right? Let's say you have to give some money to one person, you are getting loan from one person and you are settling to other person. So that is the way, the method, by transforming the obligation into another obligation. So my dears, these are the ways you can actually settle your liabilities. And let me talk about the classification of liabilities, right? Non-current liabilities as well as current liabilities. So non-current liabilities are the obligation due after more than 1 year. So the important word is here, after more than 1 year, right? After more than 1 year, not more than 1 year, after more than 1 year. It means from your financial position date to after 1 year. That's the meaning of non-current liabilities. It means usually the debentures, the long-term bank loans you are getting, everything is fall under the non-current liabilities, right? Let's say you have taken 2 million bank loan from People's Bank. So it's to be repaid over the 5 years. So it's more than 1 year period of time, right? So that is non-current liabilities actually. And let me talk about the current liabilities. These are obligation due within 1 year. Okay? These are obligations due within 1 year period of time. So the examples are here, the creditors, bank, overdrafts, expenses payable, everything under the current liabilities, right? So you have to pay your creditors within 1 year. You have to pay your bank overdrafts within 1 year. You have to pay your expenses, right? Everything, right? Let's say you have to pay your supplier, let's say 300,000 payable within 30 days, usually, right? So my dear, these are current liabilities. So the classification is non-current liabilities as well as current liabilities. And let's talk about equity. What this means by equity, as I said earlier, it's an owner's share. It means equity is what's left for the owner after paying off all the debts. It means you have the assets. You are paying all the debts, all the liabilities, current, non-current, everything. And what is left for the owner after paying for the all the debt is called equity. The owner's stake. That's the owner's true share of the business. So equity is the residual interest in the assets of a business after deducting all its liabilities, right? So so the owner is paying non-current liabilities, current liabilities, and after that, what is for the owner? So it represents the ownership value held by the owners or the shareholder, right? So usually, my dears, we calculated what? The total assets take away the total liabilities, right? Total liabilities, it will give you, that is the equity, right? The total equity, right? Right. So equity in different business structures. So in sole proprietorship, it means only one person is doing everything. You know about sole proprietorship? So this calculation reflects the owner's personal stake in the business minus. Normally, if we have equity in a sole proprietorship, full assets take away, full liabilities will give you the equity simply. But in partnership, we are having two accounts that is representing the equity. We will study later very deeply in partnership. But you have to know, in partnership, the equity is not about assets take away liabilities, but we can do it that. But most of the time, the total of capital accounts, we will have capital accounts and current accounts in partnership environment. If you add total balance of the capital accounts and the total balance of the current account, it will give you the partnership equity. So the capital account, in the sense, it reflects the total initial investments by the partners, right? It's all about the initial investments and something related to long-term investments, right? Long-term contributions, all are will come under the capital accounts. And current accounts represents ongoing profits retained, right? Day to day, you are earning something, you are making some profits, right? So those kind of stuffs will be in current accounts. So represents ongoing profits retained in the business and additional contributions or withdrawal by the partners. So partnership, it's very important. Let's say one of your partnership, you have 2 million in the current account and 3 million in the capital account. So let's say you are going to have the equity almost around 6 million, right? So we will study about that later, but just remember the total of capital accounts plus total of current accounts will give you the equity value in partnership. And let's talk about the company. Right. In a company, my dears, how we are going to say the equity is equal to owner ordinary share capital plus retained earnings. Simply ordinary share capital plus retained earnings. So the total value of funds, ordinary share capital means the total value of funds raised through issuance of shares. It means you issued the shares. If you are a private company, you are issuing the shares within your friends and family and you are getting the money, that is the ordinary share capital. Let's say for a public limited company, ordinary share capitals mean you issued the shares through the Colombo Stock Exchange to the general public and you collected the money through the banks. That is ordinary share capital plus retained earnings. It means the cumulative profits that have been reinvested in the business rather than distributed to shareholders. Right? If you are giving to the shareholders, we call it as a distribution. Right? You are paying dividends, right? But retained earnings means you are reinvested that money again and again into the business. You didn't distribute it to the shareholders. So that's something called retained earnings. Simply the profits not shared to the owners. So if you add that one, that is the equity. So ordinary share capital means the total value of funds through the issuance of shares is ordinary share, and retained earnings means the cumulative profits collected over the time. So the retained earnings balance, let's say in 2027, it is 700,000 means is collected over the 7 and 8 years maybe. So the cumulative profits that have been reinvested in the business rather than distributed to the shareholders called retained earnings, my dears. Right? So these are different businesses having a different structure to calculate the equity, but for all businesses, it's actually total assets take away total liability will give you the equity, right? And let's talk about the income here. Income is represents increases in economic benefits during an accounting period, right? Increases in economic benefit. So my dears, income is actually the money or something value that flows into your business, right? When your business earns some money, my dears, whether you are selling some products or providing some services or some other source, that's income, no? So the definition is very clear. You have to remember and memorize this definition, please. Increase in economic benefits during an accounting period. This increase comes from inflows or enhancement of assets or decrease in a liability. So increasing in assets or decreasing in liability without the contribution of owner is called income. So leading to an increase in equity not related to contribution from owners. These two very important, right? So simply you have to remember increase in the assets or decreasing the liability, but not related to contribution from owners. So owners are not directly contributing. If owners are directly contributing, it will be considered as a capital or investment, right? So income is something different. It's earned by the business, not by the owner, right? So income is anything that makes your business richer during a period. So either by bringing cash or assets or reducing your liabilities like uh, trade payables, because you are getting, let's say you are getting some discounts, right? Discounts received. It will reduce the liabilities. It will reduce the payables balances so that it will be considered as an income. We will study that deeper, okay? And the types of income is revenue and gain. So these are the types of income as per your syllabus. So revenue income is income that arises from ordinary operating activities. So the important word is here, my dears, ordinary operating activities. It means, what is the meaning of ordinary? Daily basis, weekly basis, monthly basis, every time is going to repeat. That is ordinary, right? So that's a one type of income. Let's say you are going to sell, right? You are going to sell your goods. You are going to provide your services. You are going to receive interest. You are going to receive your rent amount. You are going to receive a lease income. So it's going to be ordinary. So these are the examples, my dear. Sales of goods or provision of services, the interest received, the rent received, leasing income received. These are ordinary course of business, right? Let's say you are having a small shop. When the customer buys some groceries items in your shop, you are getting revenue. Let's say the month revenue is 500,000 sales. That is the revenue. usual ordinary business revenue. And let's say you are selling some dress in your shop for 5,000. That's a revenue, right? When you reload rupees 500 from dialogue company, the revenue for the dialogue company is the ordinary, right? Every time you scan the checkout in a food city counter, that generates revenue for them. So that is ordinary course of business revenue. And what about gain here? Gain means, my dears, it represents increases in economic benefits from non-operating activities. The important word here, the non-operating. Non-operating means it's not usual, like sales, interest, lease we are receiving, rent we are receiving. Not like that. It's a non-operating activities. So what are the examples here? So the proceeds from the sale of a non-current assets, right? You are selling your property, plant and equipment. That is a gain, because you are not selling your laptop or your building or your land every day, every month. No. So these are considered as a gain, right? Not revenue, non-operating activities. Let's say you have a very old delivery van that you bought for rupees 800,000, right? Now you are selling that for 900,000. The 100,000 extra you earned is not revenue. We consider it as a gain here. It's not from the regular business operations, no. But still it is increase your wealth, but it is gain, right? So I hope so you understand about income, right? And let me talk about expenditure here. So the expenditure is actually, my dears, the money or the value that flows out of the business. You are going to spend, you are going to give your money or something to other people, right? When your business spends money, how you are going to spend money? You will buy some goods, you will pay salaries, you will pay your electricities. That's something called expenditure. So the official definition is here: expenditure is defined as a decrease in economic benefits during an accounting period. Decrease in economic benefit, this decrease comes from outflows or reduction of assets. It means this is an opposite of assets definition. So it's the opposite of income definition. In income definition, I said it will increase the economic benefits, it will increase your assets or reduce your liabilities. Here it will decrease, right? It will decrease or reduction of assets, or it will increase your liability. That is expenditure, but it will leading to a decrease in equity, not related to distributions to or contribution from the owners are not directly related. This is done by the business, right? So you have to memorize this expenditure for definition also. So the types of expenditure, as we seen for revenue, there are revenue and gain. So operating expenses there and non-operating expenses there. This distinction is more important, because even though if you go for a high level, you must need this knowledge. So operating expenses always, my dears, these are costs arise from the normal operations of a business, right? Normal means ordinary business, everyday business, right? That is something called operating expenses. Every day, every month, you are going to have these expenses. That is, for example, cost of goods sold, right? Let's say if you are selling something, you are making cash, that is an ordinary revenue, right? For that, you have to incur some cost directly, no? Let's say you are selling something for 500 rupees, but you bought this for 400 rupees. That 400 rupees is something called cost of goods, right? That cost of goods sold, as well as you are paying employee wages, the salaries, and the depreciation of assets. Depreciation means, right, when you are using the assets, it will lose the value because of the wear and tear, right? So that is something called depreciation. So these are the usual operating expenses, right? Let's say you are having a grocery shop, right? You are paying 400,000 rupees to buy the groceries from the wholesalers. That is something called cost of goods sold. And 400,000 you will earn 100,000 profit by selling for 500,000. The 400,000, it is actually the cost of goods sold, right? And you are paying monthly salary, let's say 30,000, right? Employee wages and the electricity bill, right? Those are the operating expenses. Then now what's the meaning of non-operating expenses? The losses from the events that is outside the normal operations. It's not like electricity, it's not like cost of goods sold, right? Not repeated movements. Those are actually the losses from the disasters like fires, floods, or losses from the sale of assets. We call it as non-operating expenses outside the normal operation, right? We know the flat cam, right? So these are the non-operating expenses, my dears, right? Let's say for an example, about the floods, right? Let's say your warehouse was damaged. You lost inventory worth of 2 million. It's a non-operating expense, right? Let's say you sold your old office furnitures. You bought them for 100,000. Now, you are selling for 30,000 only. The 70,000 loss is a non-operating expense. It's not an operating expense. So you must understand about the operating expenses and non-operating expenses classification, right? So now you have the 100 percentage understanding of the five fundamental financial statements elements: assets, liabilities, equity, income, and expenditure, right? And let me talk about the components of financial statements, my dears. Now that you know the five elements: assets, liabilities, equity, income, and expenditure, let's learn about the components. Here, you must have the distinct case here. In the 1.1, I was talking about elements. In 1.2, I'm going to talk about the components. There are two things, right? Elements are always assets, liability, equity, income, expenses. But the components means, my dears, actually, these are the types of financial statements, right? It means the actual documents that make up a complete set of financial statements. So you can remember in this way: the elements are actually the ingredients, but the components are the actual dishes, right? So let's talk about the five main financial statements here. The first statement is going to be statement of financial position, formerly known as balance sheet, right? And the second one is statement of comprehensive income, and formally we call it, in a very practical way, for income statement simply. And a statement of changes in equity, statement of cash flows, as well as notes, including the summary of significant accounting policies and other explanatory information. So always remember, even if you are doing PhD level education, these are the five main financial statements, or these are the five components of financial statements. They are not going to change anymore, right? So let's dive deeply about this financial position, formally balance sheet. It presents the balance of assets, liabilities, equity, rights of the company as of a specific date. What does this mean? Simply, it's like a photograph, my dears. It's like a snapshot of your business at one moment, at that time. It means what do you own at that particular date: assets, liabilities, equity. What you owe to other people at that date: your liabilities. So what do we own means your assets, right? So what do you owe to other people is your liabilities, and what left for the owner is called equity. So we are going to show them in the liquid basis: non-current assets, current assets, right? So that is statement of financial position. It will show you the financial position. Financial position is equal to your position in assets, your position in liability, your position of equity, simply. And statement of comprehensive income, formal income statement, means it combines all income and expenditure for the period to compute the total profit or loss, right? The total profit or loss. You are going to calculate the total profit or loss by preparing something called statement of comprehensive income. It will tell you about your performance, right? It will tell you about your financial performance. This will tell you about the financial position. So balance sheet or income, or balance sheet or financial position will talk about the financial position, and the comprehensive income will talk about the financial performance of a company. And what about this statement of changes in equity, my dears? This is, it will extend the statement of financial position actually by showing how all these changes happened in the equity over the period, right? It will typically compare the previous period, right? So it's extend the statement of financial position by showing all the changes in equity over the period. It's all actually the statement of changes in equity, right? Statement of cash flow is, it will detail all the cash inflows and outflows, right? The money actually we had in the beginning of the period, what are the money totally we have received, and what are the money we totally paid. So the inflows and outflows, that is will be in the statement of cash flows, right? And notes including summary significant accounting policies, it's provide detailed explanations and breakdown of the figures presented in the main statement. Let's say you are having the revenue of, let's say, 100,000, but the revenues come from four departments, so we have to give some breakdowns in the notes, right? Along with accounting policies applied. So we will say these are the accounting policies we applied in inventory valuations. So like that, we have to give some notes and summary of significant accounting policies and other explanatory information. That also one of the type of financial statements, right? So these are the five financial statements components, my dears. Now let me talk about the measurement of financial statements, right? Measurements means when you record the value of assets or when you record the value of some liabilities in the financial statement, whether it is in financial position or income statement, wherever it is, how do you decide what number you have to write in that? So in this section, we will explain. There are four different methods of measuring the value in the financial statements, in those financial five components. So we measure something in historical cost, we can measure in current cost, present value, and realizable or settlement value. These are the measurement systems we are having in our financial statements. So let me talk about the historical cost first. So in assets, my dears, recorded the cash or cash equivalents paid or the fair value of the consideration given at the time of acquisition. What this means? Historical cost means, my dears, simply record everything at the price you originally paid. I can pay here. Historical cost means originally how much you have paid, right? For assets, that's what I'm saying. Recorded the cash you have paid, or cash equivalents. Like let's say you paid some, what do you call cash equivalents like gold or other things. For the fair value means market value, according to the market value. The fair value of the consideration given. Consideration means the money we received. Usually we call it as consideration in English term. The money we received, the money we paid, right? That's the consideration. At the time of acquisition, when you purchase the asset, it may be before 10 years, before 5 years, before 3 years. That is something called assets, historical cost, right? Let me talk about the liabilities. Recorded at the proceeds received in exchange for the obligations. The proceeds you received, it means the proceeds means the cash you have received in the exchange for the obligation. You take the obligation and you receive that money, that value you will record. Let's say you obtained 500,000 loan before 5 years ago, still it is 500,000 loan, even if it is before 5 years ago, because the proceeds you received, the money actually you received is 500,000 exchange for the obligation, or the expected amounts of cash or cash equivalents to be paid in the normal course of business. So for income taxes, we will record the liability that we are going to pay expected amounts, usually according to some calculation, right? So let's imagine, my dears, here, you are buying some delivery van, right, for 1.5 million in 2020. It is a historical cost, no? It stays recorded as 1.5 million in the books, right? Let's say you bought for 1.5 million, not 2 million. You bought for 1.5 million. It's actually now also after 7 years, 8 years times also, it is actually in 1.5 million value. Even if the similar vans now it will cost you almost around 2 million, you are still keeping that van for 1.5 million. It is historical cost. So the historical cost in a simple term, it's like your wedding album, right? Your parents' wedding album, actually, right? It shows the price of things at that time that happened, right? Not what they cost today or not the worth of today, right? That is historical cost. So in the historical cost also, we are measuring assets and liabilities. That's the one option. And another measurement, the current cost. Current cost means we have to record everything what it would cost by the same thing today. right? It is actually today's cost. In today's terms, currently, how much worth of our assets, right, that was purchased before 5 years ago, right? Or you got some bank loan, how much you have to pay now, including interest and everything now, that is current cost, right? So, for assets valued at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset were acquired currently. You have an asset that was purchased before 5 years ago, but you are not going to record in historical cost, and you are choosing the current cost. And what you are going to do? You are going to the market and you are inquiring, okay, if I'm going to buy a same kind of machineries or same kind of particular asset, how much it will cost today in the market? And that value you are going to record in the financial position. That is current cost, right? And liabilities in the current cost systems carried at the undiscounted amount of cash or cash equivalents needed to settle the obligation currently. You are not discounting because of some reduction because of the inflation or something, but you are thinking about, okay, if I'm gonna settle the amount I got before, how much I have to pay, and you are recording, right? So in the current cost system, my dears, I'm gonna give you the same examples. Let's say your delivery van, you bought it for 1.5 million, but similar van today it will cost you rupees 2 million. So instead of you are choosing the historical cost that will record 1.5 million, you are choosing the current cost. So you are going to record instead of 1.5 million, that is 2 million you are recording. That is current cost systems, right? So now let's talk about the realizable or settlement value measurement systems. How we are going to measure in these realizable or settlement value measurable systems. So assets carried at the amount of cash or cash equivalents that could be obtained by selling the asset in an orderly disposal. In the current cost, my dears, you are not going to take the value of the selling. You are going to take the value. If I purchase that asset again in today's term, how much I'm going to pay, then that's current cost. Realizable means if I'm gonna sell the asset in an orderly disposable, what is the amount I can carry, or the cash or cash equivalents, that value I'm going to record. That is settlement value or the realizable value, right? So that is the assets category. And let's talk about the liabilities recorded at their settlement values. That is the undiscounted amounts of cash or cash equivalents expected to be paid satisfy the liabilities in the normal course of business. Right? Let me give you the realizable settlement value examples, my dears. You know, let's say you are having a delivery van. Now it almost 4 years old. You can sold you could be sold that for rupees 800,000 in the used vehicle market under the realizable value. So what you are doing, you are going to record under the realizable value as an 800,000. That is the settlement value. Simply it is. Let's talk about the present value, my dears. Present value mean it measured at the present discounted value. That's an important word. You can see here for the realizable value, also current cost, we are using for the liabilities always undiscounted amount, right? But even for the present value, the measured at the present discounted value, you will learn about the discounting. You already did in the discounting and present value calculation in the business mathematics, right? That's something called present value, right? So measured at the present discounted value of the future net cash inflows that the asset is expected to generate in the normal course of business. Let's say you are having an asset, it's going to give you the cash flows for the 5 years. You are calculating, okay, for every year how much it's going to give my money, and you are going to use the present value factor, that is discount factor, to discount that money to today's term worth, and you are going to add all the things, and you are going to value that asset in that amount. That is present value method, right? So liability is measured at the present always discounted value of the future net cash outflows expected. Here, in the present value of assets, we are considering the inflows the assets going to create. But in the present value calculation of liabilities, always when we are settling, we have to give the money back. No, So future net cash outflows expected to be required to settle the liabilities in the normal course of business after discounted using the present value factor. That is present value, right? So in the present value, my dears, let's say for example, you are having a delivery van, right? That is expected to help you to earn, let's say, 200,000 per year for the next 5 years. What do? You calculate what those future earnings are worth in today's rupees using the discount rate in the present value table or the formula that we studied actually in business mathematics, and you are calculating the present value of that asset and you are recording in the financial position. That is the present value method. And let's talk about the liabilities. Let's say you promise someone to give you 100,000 next year, right? So, and you are thinking, okay, next year, if I'm going to give you 100,000, is it worth actually 100,000 to you today? No. Because of the inflation and the time of value, it might only be worth actually 90,000 today. So, you are going to record 90,000 only, but you are going to give you 100,000 in the future. You are going to calculate in today's term, right? That is present value method of liabilities, calculation and recording. Now, I hope so. You got a very good understanding about these measurement systems, my dear. So, some people can choose historical cost method or current cost method or set realizable method or present value method. Everything is allowable in the according to the standards, right? Accounting standards. Now, let's talk about the preparing financial statements for a sole proprietorship, right? We are not going to prepare financial statements according to the questions. I will give you some sort of basic adjustment descriptions. And when we are actually doing questions, I will adjust everything for you. And I will teach you how to do is very tactically. Now, the adjustments they will test for you at this examination, they will test about prepayment, accrual, income tax, depreciation, acquisition. It means, purchasing the non-current assets, and salary calculation about EPF, ETF, payee, allowance for receivables, VAT, and WHT. So these can be tested. So let me give you very brief introduction here. Prepayment mean, my dears, you paid the expenses in advance, right? Expenses paid in advance for future periods, even though the period are not at commence. You paid for advance. That is prepayment. So expenses paid in advance for future periods, right? Let's say, for example, my dears, you are paying rent, okay? You pay rent, let's say rupees 120,000 for the full year, okay? For the full year, you paid for the full year, right? But you paid the full year in January, right? So January to December, you paid in January the 120,000. So let's say in March period, okay? In March period, how many months you used? In March means January, February, March. So 3 months you used, right? The building or something. Okay, 3 months you used. So 3 months used means how much? It is actually 120,000. 12 months means divide by 12 is going to give you 10,000. So how much? That is rupees 30,000 worth, right? So rupees 30,000 worth of the money you paid in advance is already used. So the remaining one, right? The remaining one, what is actually from 120,000? If you remove the 30,000, it will give you 90,000, right? That 90,000 is called what? It is called prepayment. Okay, this is called prepayment, my dears. It is actually, this prepayment is actually an current asset, because if you are going to vacate this property in March, they have to give you the money back. So until you use the months, that is actually current asset. But the period you use 30,000 is actually an expense, the rent expense actually right now. So the prepayment, we will adjust it, right? So it is actually a current assets. So I will teach you when we are doing actual questions how we are going to do the prepayment. But this is the concept actually, right? Let me talk about accruals. Accruals means expenses incurred but not yet paid. So expenses already incurred, my dear. This is the opposite of the prepayment. But not paid, or the income earned but not yet received. We are using these accrual words for income also for the expenses. So accrual income means we earned the income but we didn't receive as a money. Accrual expenses in the sense already the expense is incurred but we didn't pay the money. So that is accruals, right? So let's say, for example, let's talk about the electricity bill. Okay, your electricity bill for December. Okay, let me talk about the electricity bill for December. Okay, rupees 15,000. This is the electricity bill, right? For 15,000 electricity bill, but you didn't pay it. Electricity bill for December 2015 for those is received. Okay, you received. So now the expense is incurred because you utilize the electricity for the December month. Then only they will give you the bill. No. So once you utilized it, the electricity expense is incurred, but you didn't pay, right? So you must still record this as an expense. Accruals, actually, it is an expense. Even though you didn't pay the money, you will consider it as an expense and you will record it as a current liability also, right? It is expense as well as is a current liability. We will teach you about the actual thing, but this is what actually, in simple words, we call it as accrual. It's an accrual, right? Let me talk about this income tax, the current tax obligations and deferred tax calculations. Let's say you earned a profit of, let's say, 200,000. That is a taxable income. And you are going to pay 40% or 30% income tax according to the Inland Revenue Department tax rates. So that is income tax. So we will teach you about those adjustments. And depreciation, my dears, this is simply a systematic allocation of assets cost over their useful life. I will teach you straight line method. I will teach you about reducing balance method and unit wise how we are going to systematically allocate the cost, right? Let's say you have a delivery van around 1.5 million. Okay, let's say you have a delivery van. Let me type it that. So you have a delivery van, right? And that delivery van, it cost means the purchased amount, right? Let's say 1.5 million. It is 1.5 million. And, it will last for a 10 years period of time. So useful life is equal to 10 years period of time. Right. Now, what you're going to do is each year, right? 1.5 million is the cost. No, you're going to allocate that cost 1.5 million to 10 years. So you're going to record 150,000 for every year until we reach the 10 years period of time. That is something called depreciation expense, my dears. It is actually an expense, right? Usual business ordinary expense, operating expense. So we will teach you in the questions. And let's talk about the acquisition and disposal of PPE. It means purchasing and selling the property, plant and equipment. Acquisition is equal to purchasing, disposal is equal to selling, right? So recording the purchase and sales of the property, plant and equipment. This is simply what it means. Let's say you are buying a new office furniture for 500,000. This is an acquisition of property, plant and equipment. Let's say you are selling your furniture, the old furniture for 30,000. That is called disposal. We will learn about how we have to adjust it. And let's talk about salaries, EPF, ETFs and payee. These are actually some employee compensation and statutory deductions. Let's say, for example, you are having a shop. So you are paying your shop assistant, let's say rupees 35,000 per month. Also, you registered for EPF contribution. So EPF, my dears, there are some contribution. Normally, in EPF, employer will contribute and employee will contribute. Okay. Let me talk about here for the EPF. Okay. We will EPF, there are two people will contribute, employer and employee. But ETF, only one people, employer only will contribute. Contribute means what? From your salary, 1% employer will give to the central bank department. So once you retire, you will collect the money. As well as you, employee also from your salary, they will deduct. Employer will deduct, but actually your salary is that, right? From your salary, they will deduct some amounts and they will give it to the central bank. So once you retire, you can get the both contribution, employer contribution as well as employee contributions. So this employer contribution for the moment, my dear, this is 12 percentage. Let's say your salary is, let's say for example, your salary is 100,000, my dears, right? Let's say your salary is 100,000. Okay. Let's say your salary is 100,000. Okay. 100,000. So is this your, if it is your gross salary, so the employer will contribute 12,000, not going to deduct from your 100,000. But employee, they will contribute 8 percentage. 8 percentage means 8,000 actually. So both these 12,000 will send to the central bank by the employer. But this 8 percentage will be deducted from the employee. So the net salary for the bank, okay, for the bank, for the employee, 100,000, take away 8,000 only, not 12,000. 12,000 is just to calculate based on the salary. But they're not going to deduct from 100,000 because it's an employer contribution. It's an expense for the employer. But employee contribution 8 percentage, employer have to deduct from the salary and send to the central bank. So 100,000 take away 8,000, you will receive the amount, right? How much? 92,000, right? What about ETF, right? ETF means, my dears, this is an employee trust fund contribution. It is actually for the moment 3 percentage, right? 3 percentage. It's actually 3 percentage. 3 percentage means 3,000. So this is also by employer. So they can't reduce from your salary. So you will receive 92,000. But for the central bank, from employer, 12,000, 8,000, 20,000 and 3,000. 23,000 will send to the central bank. Out of that, 20,000 for the EPF fund contribution to 3,000 for the ETF contribution. I will teach you how to adjust, how to deal with these questions later. But it's just a simple retirement contributions. You will get this lump sum money, in your retirement, right? So we will talk about that later. And let's talk about allowance for the receivables means these are some provisions, my dears. Provisions means, something is going to make losses in the future. So that's what we are providing some expenses and liability under the prudent concept. You studied about prudent concept, right, in the level 1 financial accounting. So that is something called provision. So the provision for doubtful debts, it means we show them for the credit and we have some doubts whether we are going to receive that amount or not in some percentage, right? That's the allowance for receivables. Let's say, for example, you are running a restaurant, right? You have 200,000 rupees to receive from your customers, and you are estimating from your past experiences, and you got some intuition. Okay, from this 200,000, I am having a doubt for 5%. It means 200,000 5%. What is that? 200,000 cut 10, that is 20,000. Divide by 2, it will give you 5%. That is 10,000. So you are estimating 5%. 10,000 may never be collected. So it is a doubt for you, not 100% sure. If you are 100% sure, we call it as an irrecoverable debt. But if you are not 100% sure, it's called doubtful debt. So you are going to give you allowance. So we have to deal with it. And VET and WHT, value-added tax and withholding tax. Now the value-added tax, withholding tax name is called it, advanced personal tax deductions, right? API, advanced personal income tax, like that, right? So value-added tax, let's say, when you are selling some goods, you will charge the VAT, right? So let's say you are charging 18% VAT. How you are going to calculate the VAT? You are going to pay to the government because customer is paying the money including the VAT. Let's say you billed for 100,000 and 18% VAT, so 118,000 you have collected. So now you have to pay the 18,000 to the government now. How we are going to do the accounting for that, right? So how WHT is deducted? WHT actually not in the scope of your thing, but I will teach you, okay? So these are the detailed adjustments and descriptions we will explore when we are actually doing the papers, my dears. It's not a business studies or economic papers, my dears. This is actually financial accounting. So note should be very short to get the knowledge, but practice will give you the entire marks, right? So we have to talk about Sri Lanka accounting standards, right? So Sri Lanka accounting standards, my dears. In these sections, I'm going to explain you some rules, some guidelines that Sri Lankan businesses must follow when they actually prepare the financial statements, right? So every business in Sri Lanka, they should prepare the financial statements. But let's imagine if every business in Sri Lanka prepare their financial statement differently. Some people recording expenses in one way, others doing it differently. It would be chores, right? That's why we have Sri Lanka accounting statement standards, a copy version of International Accounting Standards IAS. That is Sri Lankan accounting versions, right? That's why we have Sri Lankan accounting standard, a common set of rules that every business must follow to prepare the financial statements, right? So the types of accounting standards in Sri Lanka, the framework structure is here, my dears. We are going to have SLFRS. There are 16 SLFRS and 25 L cases. So SLFRS means Sri Lanka Financial Reporting Standards. What this means? In simple terms, it's the copy version of IFRS, International Financial Reporting Standards. Some places they have adjusted according to Sri Lanka norms. And LKS means Lanka Accounting Standards. It's a copy version of IAS, International Accounting Standards. Right? So based on International Financial Reporting Standards, we have SLFRS. There are 16 SLFRSs. Based on International Accounting Standards, we have LKS, 25 LKSs. Right? So Sri Lanka Accounting Standards, LKS or SLFRS. Right? So now we are going to have, there are three types, okay? There are three types. So the first one is Sri Lanka Accounting Standards. We call it LKS or SLFRS. And Sri Lanka Financial Reporting Standards for SMEs. We call it for SLFRS for SMEs. Normally they will test in your examination. And there is something called Sri Lanka Public Sector Accounting Standards. So we have LKS, SLFRS, and especially we have something called SLFRS for SMEs. An important word, okay? For a small medium enterprises, SMEs means for small medium enterprises, we have something, a new book, SLFRS for SMEs. As well as public sector means government sector, they are having a special accounting standards, rules book. Right. Let me talk about the Sri Lanka Financial Reporting Standard for SMEs. Right. So it is mandatory, my dears, all listed companies. I'm highlighting the word listed companies. Listed companies means what? It means these companies are actually registered their name. They are registered to issue the shares of that company to the general public. Any person in the public can go to the Colombo Stock Exchange and buy their shares. Those are listed companies. So all the listed companies, as well as all the banks in Sri Lanka, all the financial institutions like leasing companies and other companies, all the insurance companies, all the insurance companies, right, and other entities, right, in other entities with a public accountability. If you are dealing with public money, you have to prepare your financial statements following mandatorily the SLFRS and LKS. There is no exception. If you are dealing with public money and insurance companies, financial institution, and bank, any listed companies, they must prepare their financial statement using SLFRs and LKS. That's what the demand for the financial accountant, the demand for the chartered accountants, this demand for the ACCA people is so high, right? So that is LKS and SLFRS story, right? Let's say, for example, you are in a medium size, let's say, so not medium size, let's say your company is listed on the Colombo Stock Exchange. Like John Keel's Holdings, they have listed company. Dialog Exiata is a listed company. And HNB, Hutton National Bank, it's a bank. These kind of companies, they must follow the LKS or SLFRS. Right? Let me talk about the other category. Sri Lanka Financial Reporting Standards for SMEs. So, my dears, the listed companies, very large companies, billions of revenue, the banks, the financial institute, insurance companies, other entities, they are managing the public money in billions of money. So we can't expect the same regularity for small, medium businesses. No. That's what in Sri Lanka we are having a separate standards for small, medium enterprises. Small, medium enterprises means not 100,000 or 10,000 rupees, my dears. It is also in millions, right? So under the category specified here, it is required for small medium enterprises that do not fall under the category specified for LKS SLFRS. It means if you are not a listed company, if you are not a bank, if you are not a financial institution, if you are not an insurance company, if you are not an other entities with public accountability, you can prepare the SLFRS for SMEs. It means you can follow the SLFRS for SMEs to prepare your financial statements for your small medium enterprise. Right? We will study about that later. And Sri Lankan public sector accounting standards mean, my dears, public sector. That is normally, my dears, all the government entities, our education ministry, our government schools, government is having some banks, those are public sector, no? They don't normally engage in commercial activities like, earning profit most of the time. But having, even government, they are having the government companies that is for profit. But the public sector, most of the time, they're not engaged in commercial activities. Let's say government hospitals, some state public universities and provincial council, they follow these standards, not LKS SLFRs. They have separate. So public sector entities that do not engage in commercial activities, they will follow Sri Lanka public sector accounting standards. Right? So this is how Sri Lanka accounting standards framework is working, my dears. Now you have a very good understanding about Sri Lanka accounting standards. Now let me talk about why it is the importance of Sri Lanka accounting standards, why they have to follow the Sri Lanka accounting standard, why they have to follow the small medium enterprises SLFRs for SMEs, why government sectors have to follow the standards. The thing is, my dears, statutory requirements. Statutory means legal, right? Because legally specifies that certain business enterprises identified as a specific business enterprises, SBE, very important word, okay? Not SME, okay? I'm not talking about SME, my dears. SME, small medium enterprises, that's the different story. This is SBE, specific business enterprises. There are some companies, there are a list of nature of companies, we list it under the SBE. I will teach you that later. Are mandatory comply with Sri Lanka accounting standards when preparing and presenting financial statements. Non-compliance, it means if they are not preparing their financial statements according to the LKs and SLFRSs, it will allow the Sri Lanka Accounting and Auditing Standards Board, it means the monitoring board, to take legal action, right? Legal action against the enterprises. That's what they must follow the accounting standards, right? And let's talk about the Companies Act number 7 of 2007. Why it is important here? Because the Companies Act number 7 of 2007 is requiring all companies, whether it is a private company or public sector company, whether listed company or unlisted company, they are requiring all companies to prepare and present their annual financial statements. Right? Every annual, please prepare every year accordance with the Sri Lanka accounting standards. That's what the demand for the accountant is so high. And let's talk about the best practice. Even though if it is not a mandatory requirement according to the Companies Act or there is no statutory requirement, the best practice is preparing the financial statements. No, so because of that only you will understand your business, what's happening in your business, whether we are performing well or not. We need the income statement to get to know, right, whether we are making profit or loss, the costs are under control or not, the revenue is enough to cover the expenses or not. We need the income statement. We must know what are the assets we are having in our company, how much it is depreciated, what are the bank loans we have, what are the prepayments we have made, what are the accruals we are having right now, what are the current obligations, non-current obligations, what are the investments we made in other companies. So we must know. So not legally required for all businesses. While not legally required for all businesses, it is considered best practice to prepare and present the financial statements according to the Sri Lanka accounting standards. It will ensure financial statements are of the highest quality and are well regarded by all organizations. That's also one reason. And the another reason is business and financial credibility, my dears. Right? Businesses, they must submit their financial statements to sometimes to banks when they're obtaining financial facilities. So that's what I said. You know, when obtaining the financial facilities, we must submit. If you are going, even if you are a sole proprietorship business or simple small company, if you are going to obtain some bank loans, they will ask you, okay, give me the financial statements for the last 5 years. I want to check your profit. I want to check your financial position. I want to check your ability to pay the interest. For that reason, as well as for the taxation purpose, audited financial statements complying with these standards. Normally, For the taxation purpose, you need the audited financial statements are required for income tax submission, right? Even let's say you file your income tax return with the Inland Revenue Department. If you want to file that with the proper numbers, you need a proper financial statement. Then only you can adjust for taxation. So these are the importance, and these are the Sri Lanka accounting standards framework in Sri Lanka, my dears. And in your syllabus, you must know about the LKS 2, LKS 8, LKS 10, and LKS 37, right? These four standards actually I will teach you in the next sessions, right? I don't want to overwhelm you with a lot of information. Now you know the basics are basics, right? In the next sessions I will cover about these LKS 2, LKS 8, LKS 10, and LKS 30, LKS 37. Then after that we will dive very deep into the questions that is related to your chapter 1, right? We'll do the past papers for the chapter 1. Then after that only we will move to the chapter 2. Then only we can accumulate the knowledge over the next chapters, because it is an accounting paper. It requires the knowledge of the previous chapter to do the questions in the subsequent sections, right? So that's it for today's session, my dears. Let's see all of you in the next sessions. Have a great day. Thank you all. See you. Bye.